Hello, we're Team 5 and we're going to tell you about our managerial cost accounting project on American Guitars Inc. My name is Victor Bagdasar.
Stacy Ho.
And Elisa Esparza.
And I'll begin by telling you about how we got our rates and applied the rates to costs. So I'm going to tell you about the rates and how we got them and how we applied the rates to get costs. The rates are based on the budgeted overhead for the month divided by budgeted cost driver for the month. In our case, the cost drivers were the direct labor hours. The cost driver we use for budgeted amounts are based on the practical capacity of the company, American Guitars, which is the best capacity for product pricing. For example, American Guitar Inc. requires 2 hours per unit of beginner model for the construction department. This 2 hours per unit multiplied by the practical capacity of 4,500 direct labor hours gives us 9,000 direct labor hour practical capacity. There are 3 sets of rates: fixed rates for the support department overhead, variable rates for the support department overhead, and 1 rate, variable and fixed, for the direct departments. For the fixed rates for support department overhead, we take the fixed rates, multiply it by the budgeted hours, which we got from previous year's budget, and by doing that, it ensures the hours are entered at a standard amount of overhead, and that's applied to the WIP. Variable rates for support department overhead is multiplied by the actual hours, and the 1 rate, fixed and variable, that we get for the direct departments, we use a slope regression analysis of 2013 direct overhead costs to get a rate to then apply to the budgeted variable overhead. Now, to allocate the indirect plant overhead to the direct departments, we took the budgeted plant overhead and allocated it to the direct departments based on the relative percentage of budgeted overhead by the direct departments. This overhead is then included in the budgeted amounts to get direct rates. To allocate the maintenance overhead to the direct departments, we took the maintenance overhead generated from the dual rate method and applied it to the 2 direct departments based on relative percentage of overhead applied using direct rates. The overhead is then applied to the jobs. Now, to allocate the design overhead to the jobs, we took the design overhead, generated and applied it to the jobs based on the relative percentage of total direct labor hours.
Now I'm going to begin to discuss American Guitars Inc. January performance. As far as their performance for January, American Guitars Inc. had an operating loss of $34,802.35. This loss was largely due to their high cost of goods sold. Their cost per unit of beginner models was around $520 for the month of January, and their selling price per unit was $600. That leaves them with roughly only a 13% profit on the sale of each unit, hence the high cost of goods sold. When taken into account other operating costs and ending inventory, it is not difficult to understand why they have an operating loss at only 13% gross profit margin. The same applies to the professional model, which costs were roughly $875 per unit at a selling price of $960 per unit, leaving them with a gross profit margin of 9%. In addition, the unit cost for the beginner model and professional model increased about $70 and $75 from last year, respectively. Lastly, their under-applied overhead of around $24,000 illustrates that their budgeting costing method budgeted costs are too low of a rate, or that they use much more cost than they budgeted for, both resulting in poor cost management. Next, Stacy will discuss American Guitars Inc. costing systems.
In this assignment, we were asked to indicate any appropriate action that management should implement to enhance its costing system and strategy. We were also given the task to recommend management of American Guitar Inc. on whether they should keep the current cost accounting system or to implement a standard costing system. We believe that the predetermined manufacturing overhead rate for product pricing purposes is not the best rate for management of American Guitar Inc. The absorption method that they use inventorizes variable and fixed costs. Fixed costs are related to the practical capacity and not the actual units produced. If fixed costs were expensed each period, they can get a more accurate product price. This leads us to recommend a variable costing system where fixed costs would be expensed on the income statement each period rather than left on the balance sheet. The large balance in the ending inventory is another factor why we recommend the variable costing system. A large part of the ending inventory is made up of fixed costs. Also, in a variable costing system, American Guitars would be able to price products based on the cost of manufacturing and sales, enabling more accuracy in pricing products. Lastly, we recommend that management implement a standard costing system rather than the normal costing system because direct materials, direct overhead, variable overhead, and fixed overhead costs entered inventory at a standard cost rather than actual costs like it does in normal costing system. With the standard costing system, management can identify any variances that exist between the costs at each level of production stage, whether they use job costing or process costing. That concludes our presentation for today. Thank you.
And that will conclude Team 5's presentation on American Guitars Inc. costing systems. Thank you.